Hi, welcome to Market in a Minute. We think the market will likely rotate, and if it doesn't, we're going to see a pretty significant decline. And we're kind of at the point where the seasonality of the market is really weak. So it could likely come kind of in the middle of July until maybe the middle of September. I got a crazy chart to show you. I mean, it is truly crazy. It comes from Ned Davis Research, and then how to play this potential rotation. If you go back and look at 1998, 1999, and then the massive rotation that started to occur in 2000. So it's very similar to what we think we're seeing currently. The amount of stocks that are outperforming currently is at the lowest level, I think, on record. You might go back and look at the depressionary period of the 1930s, and maybe that there are some periods there where there's fewer stocks that outperform the S&P 500. But currently, there's only 25% of the stocks that are outperforming the S&P 500. That's just a crazy statistic. So if you analyze this, what happens is you get these massive concentration of money, and then it all kind of comes unwound, and you see big outperformance by the rest of the market, or you get this movement from growth to value. So in this period of 2001 and 2002, you saw this major decline in the overall market, 49.9% from high to low, and value did really well through that period. There were some up years in value during this massive decline. So we think something maybe on a smaller version of that could occur starting here in the next couple of weeks. We see the rotation into maybe the late cycle stocks, or maybe it flips back to early cycle. But we think there's going to be rotation. So we want to broaden out our ownership like we are currently positioned, but we want to broaden that out. So instead of the market just blowing up, we think there's going to be a rotation. But if it doesn't rotate, then we've got a really nasty correction, if not bear market, coming our direction. So value versus growth. So this is really interesting. So when you get these, these pile-ins into growth stocks, it comes unwound at some point, and then the value stocks outperforming. We're not making a case that value should necessarily outperform. We just think that the other 75% of the market should be performing a lot better. So if you look at these periods, so the blue here is when growth outperforms, the dark here is when value outperforms. You can see these massive cycles here. Usually these cycles last about 6 years. And this cycle here lasts about 7 years. It's 2001 through 2008. And then this cycle has been into growth, roughly 16 years of outperformance with just a little bit of outperformance by value in 2016. So very long period of massive outperformance by growth, and value has lagged considerably over that period. So we're thinking what occurs currently is you don't necessarily get a major shift at this point into value, but you get a major shift back into the rest of the overall market. So where are we in the economic cycle? I think this is really interesting. We're late in the economic cycle. So, from our standpoint, is the Fed is going to have to start cutting interest rates, not wanting to cut them, but have to cut them. We think that maybe in September we get a rate cut, as we might see negative growth in the third quarter, if not the fourth quarter. So the economy is really slowing, and we might see some rate cuts because they need to do it, and hopefully inflation comes down and stays down to allow the Fed to do this. So if you look at the different economies here, the U.S. is probably closer to the edge of going into a contraction. Japan's already been in a recession, but it continues to slow down. Parts of Europe are in a recession. China is maybe starting to come out of it, but they've been struggling economically for a while now. So every major economy globally is in this late cycle slash recession period, and we think that the central banks around the world will continue to cutting rates as we go into the latter part of 2024 and 2025. Generally speaking, cutting rates doesn't necessarily mean it's positive for the stock market. However, this time it could be if we can alleviate that recession and keep inflation down. What does this look like? So, if we're late in the economic cycle, right? Here's where we think we are. Why is technology and communication services, why is this outperforming? Well, there's a cycle occurring in tech. That's why it's outperforming. Otherwise, the traditional areas would likely be outperforming. Real estate has their own problems. Consumer staples, it's been on and off, but we think consumer staples would be a likely place for people, to investors to go to, and then particularly so if we enter a recession. Energy, we think, is poised to have a good back half of the year. And utilities have been, somewhat positive this year. They tried to have a nice run. They did a little bit there. But in a recession, these stocks will outperform nicely. So if the Fed can pull it off, if they can pull off that soft landing and cut rates enough to reinvigorate the economy, we think they need to cut rates about four times or more to get the 30-year mortgage down into the five handle area. So 5% on the 30-year mortgage will likely get the housing sector starting to move again. You'll see these early cycle stocks start to percolate some. You'll see the rest of tech maybe starting to perform better, not just the mega cap AI plays, but all those cyclical technology, semiconductor companies, and hardware companies as well. So if the Fed can pull this off, this is a real big benefit to the overall economy. If they're too late, so if they can't pull this off, this reminds me, Palace Position reminds me of a Western movie where the woman's laying on the tracks all tied up and the train's coming. He's got to step in there and cut rates, otherwise we're going into a recession. So not sure which direction this is going to go. I think that inflation report on Thursday is going to give some direction as to what the Federal Reserve can do. And if they don't cut rates sometime this year and into next year by at least 1%, we're headed to a recession. And that may not be actually enough to really stave off a recession, but that's what we're currently thinking. And now, expecting a correction. So here's how we're entering the earnings season. The technology expectations are really high, right? So these stocks have done great. Expectations are high. They better beat and guide up in a big way. Otherwise, these stocks are coming back down. And then the economically sensitive stocks, there's not enough growth in the economy. So the first quarter was up 1.4% GDP growth. This quarter looks about the same, if not maybe lower. We'll have to see how it comes in. And then the third and fourth quarter, I think, are very suspect at this point. So the economically sensitive stocks is not a good backdrop for those at this point in time. So seasonally, we are entering a really tough period for the S&P 500. So July 15th is generally the date, the line in the sand when the markets start to really roll over seasonally, and it'll last through most of September. So we're thinking that down around the 200-day moving average, which would give us a correction, that's where we're headed, unless we get this nice rotation to occur. So rotation first, correction second, that's what we're hoping for. Baxter International, high quality blue chip healthcare company. This stock is down over the last 2 years from $90 down to $33 and roughly 60 cents. So we've been trying to find the bottom in the stock. We think there's great value in this company. We think the kidney dialysis business alone, okay, is worth $4 billion, which is about 25% of the market cap of the company. That could be used for all sorts of really good things, maybe to buy back shares. Um, so this is a blue chip company, high quality, cheap valuation, 11.4 times earnings, where it has traded generally around that 20 or 22 times earnings historically. We think there's 50% upside if you get a rotation. If people say, okay, I need to own value stocks now, this is a screaming value stock. This used to be a nice growth stock. It's looked at as a value stock. This could have really 50% upside in a very short period of time. And the catalyst is they are monetizing some of the company here soon. So are there more things to come out on this company? Maybe, maybe not, but we think that the management team is resolving them and there is untapped value in this company. So we like this a lot. We wrote a white paper, so I can't believe I do things like this at times, but I think it's important to understand how to use levered ETFs. We use ETFs to hedge portfolios. So we use the unlevered inverse ETF and a levered ETF, and we also use the double on the S&P 500 in our growth portfolio when we want to provide some extra oomph to the performance. So these securities are considered highly risky, and we think if they're used properly, they can be a big benefit to a portfolio. So the critical point of this white paper we did was the most important thing is to weight that security properly, and then watch the volatility. So the reset's important. The volatility, we don't think it's a big issue. It's just compounding. Things happen. We don't have enough volatility in the market to really be a significant issue. But I could see if you're selling this, if you're an ETF provider, you want people to understand that these are meant to be used only on a daily basis, but we find them very effective to use to get increased returns in the portfolio by properly weighting it and also hedging the portfolio. So we'll send that paper out later in the week, or come to my website, Patrick M. CFA, that we'll have that white paper up sometime this week. Thank you very much. Please hit like, come to my website, sign up for Market a Minute, and remember, Thursday's the CPI report. Take care.